Good morning, hello, and welcome to Trading Hour. It is 11 a.m. on the 26th of December. I'm Surabhi Upadhyay. With me is Vivek, and it's the first time that Vivek and I are teaming up to do Trading Hour, right?
That's right. It's a pleasure to work alongside you.
Fantastic.
On this Boxing Day.
No, absolutely. Something new on Boxing Day, right? Yes. But what's not new is the shape of the market. This is a repeat pattern, and a pattern that we've come to know this week, that we start positive, even though it's holiday thin trade, it's, the so-called Santa Claus rally, but Santa doesn't last on the street. He quickly heads to the exit, and that's the problem that's playing out right now. Vivek, we opened up quite nice and steady, and whichever small, regional markets, a few markets that were open, they're all tracking gains. Wall Street had a positive handover on Tuesday, but despite that, it's very clear that the market's finding it very, very hard to retain even a 40-50 point gain at this point.
You're absolutely right. We opened up a small gap up, but sharp sell-off, and it's kind of mirrored the kind of moves that we've seen in the last 2 to 3 trading sessions. Well, a couple of stocks that we'd like to highlight. First up, have a look at the broader end of the markets as well. That's a clear underperformer today, especially when you're comparing it to the benchmark indices. Now, one particular stock from the broader end of the market that we are tracking is Cummins. Now, in the week gone by, you saw Siemens fall almost 15%. This was on the back of muted commentary that the company gave as far as the analyst call was concerned in terms of very moderating private capex. And the analyst takeaway there was that the total addressable market for Siemens had fallen. Now, what's actually happened is that on Monday, Motilal Oswal, did a couple of channel checks, and they came out with a report where they're talking about the diesel genset business, where Cummins is majorly present in. And they're saying that demand was weak as far as October and November was concerned. They're also saying that players have been forced to take some price cuts. And the back of that, markets have taken note of that, down almost 4.5% is the one that we're seeing as far as Cummins is concerned. And the second stock that I'm looking at is J&K Bank. Change at the top. Amitabh Chatterjee has been appointed as the MD and CEO as a period of 3 months. Very interestingly, he's currently the deputy MD of SBI and also served as the MD and CEO of SBI Cap. So strong name over there. Stocks liking it, markets liking it, up almost 5% even in this week market.
Absolutely. I mean, J&K Bank has been doing really well on the back of this development that Vivek just pointed out. But overall, the color has changed very quickly for the banking sector. When we started, the Bank Nifty was the best performer. At one point in time, around 10 o'clock, the Bank Nifty was up a whole 1%. And since then, it's completely cooled off in a big way. Quick movers and shakers on the Nifty before we tell you about the lineup and the guest on the show. On the downside, where is the weakness coming in from? Because a lot of these large stocks, they've sold off. In the banking names, you can look at an ICICI Bank, for instance, an HDFC Bank. Suddenly, the color is very different on these stocks, and that explains what's been going on. Let's get them up on the screen. There you go. They're all mirroring. It's the same chart pattern, whether you're looking at the Nifty, the Bank Nifty, or these individual names. In addition, what else is weak? Today, you don't have Reliance contributing. Lever is quiet. TCS is down. So some of these large cap, big boy names, the heavy hitters, they are the ones which are becoming a drag for the market for the time being. However, on the upside, keep an eye out on the auto names, because some of them are managing interesting moves. But remember, we need to sort of caution that with the expectation of thinner volumes and also the fact that it is expiry. So there will be some of these moves that will play out today as positions get settled. Maruti should be coming up. Yeah, Maruti is up about 2%. It's the Nifty winner. There is Bajaj Auto that's also doing pretty okay. And Hero Moto and Tata Motors. So all in all speaking, it's a pretty okay session so far for the auto pack. But over the last couple of days, of course, we've been talking about the big stars of 2024, and one such company obviously is PG Electroplast. The stock has done really well, and the space that it operates in, the electronics manufacturing space, it's a red hot pocket in the market. Valuations have been going higher, but then order books are also swelling. So Vivek, why don't we take it away, because we have fresh news on PG Electroplast, right? In fact, the announcement, the latest announcement that came in is that they're getting into a venture, a pact with Whirlpool for manufacture of the washing machines as well. So actually, let's take the conversation with Mr. Vikas Gupta. He's the managing director of the company. Mr. Gupta, thank you very much for joining in, and season's greetings to you. It's been a fantastic year, I think, for PG Electroplast. Your shareholders will also be very, very happy. Let's start by understanding the contours of this latest announcement, the tie-up that you have with Whirlpool. What are the expectations in terms of the volumes you'll manufacture, what products, and what's the revenue estimation from this tie-up?
Greetings to all at CNBC-TV18. We have been in discussion with Whirlpool for this washing machine business for quite a while, and we are happy to announce that we have been able to convince them to look at outsourcing as an option. And we see a strong momentum in our washing machine business with this deal. And we are confident that we should be able to maintain a CAGR of almost around 30 to 40% for coming 3, 4 years in our washing machine business as well. So it is difficult for me to give you a client-specific revenue numbers as we are bound by the NDA norms in that. But definitely the overall deal will be very very helpful to us in talking to other customers as well to convince them to look at the outsourcing in the mass segment products where the pricing is always a pressure point for all the brands.
Okay, Mr. Gupta, you've already been working with Whirlpool for other segments. So overall, as a percentage of total revenues, give us two segments. Number one, what does Whirlpool currently contribute? If you could give us a client-specific breakup. And secondly, as a percentage of your overall top line, what does washing machines contribute? Because at the end of Q2, you actually gave us an upgraded guidance for FY25. So on the back of that, if you could give us a breakup of where exactly are you seeing accelerated growth coming in?
For us, in our product category, which is almost around 70% of our overall company revenue, washing machine is almost around 20% of that. So when we look at the overall revenue from washing machine, we are given a guidance that we will be doing a revenue of almost around 450 to 500 crores in a washing machine category in the current financial year. So, and the overall guidance for the revenues still stands at 4,250 crores. We might be updating our revenue guidance going forward once we release the results for quarter 3 of FY25.
Okay, all right. So that would be interesting that you could be upping your revenue guidance as well. Earlier, I think what the outlook was, and correct me if I'm wrong, I mean, earlier you were looking at revenues of around 4,200, 4,300 crores for the year, and that could be revised higher now, you're saying.
So, Survi, I have said that we will be updating our revenue guidance.
Yeah.
I'll keep it that way for now. And the revenue guidance earlier that we guided was for almost around 4,250 crores. And we'll provide an update as we go forward. So the run rate is looking good, and we should be updating on that once we release the quarter 3 results.
Okay, so Mr. Gupta, what we understand from what you've said currently is that Q3 has tracked well. You're expecting Q4 also to be good. So some slight upgraded guidance may be in the offing as far as FY25 is concerned. You've also maintained that you will do a CAGR of close to 35 to 40% in the coming few years. So FY26, have you taken into account the contributed financials from Whirlpool, or would we see some upgrade coming in there? And internally, have you worked out any guidance for FY26?
So Vivek, we will be surely making a guidance on the FY26 numbers also. Our teams are already working on it and doing their number crunching. And this Whirlpool deal will definitely help us in further boosting up our guidance for FY26. But we will have to wait for a few more months. I think we should be making a specific guidance on FY26 once we close FY25 numbers and we make an announcement on our FY25 numbers. At the same time, we will be releasing a guidance on FY26 numbers also. But we are confident that we should be able to maintain a CAGR of 35-40% very, very easily for the coming FY26, FY27 as well.
Just to understand, washing machines, like you said, I think are 20% of your business, I mean, the contribution that's coming in over there. Will you have to add additional capacity to service the Whirlpool contract? Or is the current capacity enough? And Whirlpool itself would have, I'm guessing they're working with multiple contract manufacturers. So how much of their business incrementally could be coming to PG?
So we are in process of expanding our capacities in washing machine business as well as in our AC business as well. So currently we have a capex guidance of almost around 370 to 380 crores for FY25, which we are closing. And for FY26, we'll be making a capex guidance. But definitely, we are increasing our capacity for washing machines to almost 2.4 million units per annum. The Whirlpool, in case of washing machine, is working currently only on with PG Electra. So for washing machine, I don't think Whirlpool has any other contract manufacturer in washing machine space. So definitely, the washing machine business will get a further boost with this deal from Whirlpool, and we are still working with Whirlpool to to figure out the exact numbers and how it will play out in coming 2-3 years.
Okay, Mr. Gupta, a couple of questions from our end. Number one, on 21st November, you informed the exchanges that you were entering into the EV space with an African company. So what exactly is the scope of work you'll be doing over there? What will be the kind of contribution you're expecting from these particular verticals? And secondly, FY26, any kind of value unlocking we can expect, because a couple of peers like Amber Enterprises are actually looking at demerging some of the verticals. They do indicate, there could be some value unlocking, especially for investors, given specific business lines that they are present in.
Coming to the EV bike announcement, we have tied up into a manufacturing agreement with Spiro, which is an Africa-based company. And we will be undertaking a manufacturing for a complete EV bike, as well as the battery packs for them. And we expect to start the production by, I think, before the end of first quarter of FY26. We should be starting the trial production for them. And we are looking at a revenue of almost around 500 to 600 crores in the first 2 years of within the 2 years of our operations for EV bikes. So we are very bullish on this business segment as well, and it will further boost up the numbers for our FY26 revenue, which will be giving guidance in due course of time.
Got it. So, Mr. Gupta, as we wind up, give us sort of big picture vision. And I'm now not talking about Q4 or Q1, but say, something that an investor can work with for 12 to 18 months down the line, because there's so many businesses that are now firing up for you, right? There is washing machines, there's air conditioners like we spoke, there is, there's obviously this, the battery pack business, EV that we just spoke about. So on a whole, what will your revenue pie look like, say, 12 months down the line? And as you add these newer businesses in, what will the margin profile of the company be? What is it that you're aiming for? Currently, I think as of the second quarter, you were at around between 8 and 8.5% margin. What will the company look like in terms of the revenue mix and the margin profile 12 months down the line?
So, what I can say is that all the product segments that we are working currently, we see a very large and very huge opportunity in all the businesses that we are in. And we hope and we feel that it is possible for us to achieve a CAGR of 35 to 40% over a period of the next 3-4 years. And we translate if this CAGR growth of 30-35% into 3 years. So we can see our revenue doubling almost in next 3 years. So we are confident and we are aligning our resources, our capacities based on these projections. And we are working to harness all the opportunities that are coming in our way. And we are building on that. So we are extremely confident in all the product categories that we are working on.
So 35 to 40% CAGR revenue growth over 3 years. And what about the margin profile? What would you aspire for as all these products get into the mix?
I would not like to give a very strong positivity on that margin profile. We will like to maintain a margin profile of around 7.5 to 8%. We have to see how the competitive landscape also operates. And please understand, this still business is a very commoditized business. And we are into a manufacturing business where the margins cannot be very large. But definitely, we try to maintain a ROC of almost around 18 to 20%. That is what our guardrails are there for any kind of capital allocation that we do in our business. So we feel that the margin profile will be similar to what we have right now going forward as well.
Thank you so much, Mr. Gupta, for joining us and giving us a sense of the partnership, the opportunity that you have with Whirlpool and also the way forward. Wishing you and your team a very happy 2025. Well, let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Well, let's now shift our focus to the commodity space. Manisha joins in, and today we are focusing on national gas.
Well, thank you for that, Vivek. You know, there are 3 or 4 commodities in 2024 which have given you that kind of a return. Coffee is up perhaps 70%. Cocoa prices have gained up by 120%. And then there is natural gas. The prices have gained up by 67% in this year. And with the kind of gains that we have seen for natural gas, this is the highest since December 2022 that we are trading in at this point in time. Well, it is cyclical, and some of this is short term because we are looking at strong demand because of the winter season. And then there are geopolitical concerns as well, because accessing the natural gas which flows from Russia via Ukraine to Europe is something that is becoming a concern right now as we are looking at more sanctions coming in. So that's the second reason that you have seen prices gain up quite strongly. The third is when you look at the US markets itself, the domestic consumption is on the higher side. And then the LNG demand globally has been firm. And then the US President-elect Trump has been saying that he would issue more quota when it comes to LNG exports to the world. That clearly has had a lot of gain into the prices. The other point also comes in from EIA, which did come out with its data in the previous week, suggesting that the gas storages have declined by a big 100 billion cubic feet. Now, we are trading below 10-year average at this point in time, and that has been yet another factor which has been supportive. Markets do believe that we will start 2025 on a positive note, and the next year could be yet another year where you could be looking at very strong prices.
Okay, all right, got that. Manisha, thank you very much for the latest from the commodity markets. We have to take a break, but as we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or from Google Play. Welcome back. You're with us on Trading Hour. We're putting the spotlight on a few stocks now. Ola Electric had an electrifying start in the morning. There's a fair amount of news flow. We've been hearing about the company setting up more centers, more feet on the street, on ground. Plus, there is a lot of chatter about some of the newer models that they have launched as well. So Darshan is here with the latest. So what are you picking up on Ola?
So Ola stock has come off opening high. At one point, stock was up almost 6%, but still it's in the green. It's up 1% currently. So the reason is Ola has increased the store expansion. Now total stores are at 4,000. In one go, company has added more than 3,200 stores. Now the positive part is with these 3,200 stores, company has co-located service centers as well. This is important considering the service issue that company has been facing in the past few months. And apart from these new store additions, companies also launched the beta version of operating system named as Move OS 5 beta version. And some of the features include, first one is group navigation, second is live location sharing. Also, it has launched limited edition of Ola S1 Pro Sona, and as per company, it's launched with real 24-karat gold-plated elements. But apart from all these things, the major positive for the stock is the addition of 3,200 stores with service center. That's the reason the stock is holding on to the gains. Minor gains, it's still, but it's up.
Thank you so much for that, Sudarshan, for joining us and giving us details about Ola Electric. Well, moving on, Vishal Malkan from malkansview.com joins us for a quick technical check on the market. Good morning, Vishal. Thank you so much for joining us. What are you making of the markets at the current levels? Do you think we could see some bounce, going into year end?
Yes, good morning. I think typically last week of December has been always positive in the last almost 9 out of 10 years. So we can look at some bounce from here, and also Nifty, the way it is making kind of patterns on daily chart. It looks like it's finding its feet around these levels of 23,700 and 800. So we can look at bounce around 24,100 to 200 in the next few trading sessions.
Okay, so you're expecting a bit of a bounce in the next couple of sessions. Vishal, hi. Season's greetings. What about individual stock trades? Anything today or anything positional? What are you working with?
So I'm looking at pharma space, which has been the most outperforming in the last few months in spite of the market correction. And one which I'm tracking right now is Lupin, which has broken above that resistance of 2150 and sustaining above that consistently. So I'm looking at even a short term as well as a positional trade there with a stop of 2160 for targets of 2250 and 2300 in the coming days.
Vishal, one particular stock today that's seen a bit of a beating is Cummins. It's down almost 5%. Capital goods, anything you like in this particular space, or do you see further downside? Siemens is down 15% in the last 3-4 trading sessions. Even Cummins today has taken a bit of a beating.
Yeah, so Cummins, I think, has been in a kind of a consolidation mode, and today it has broken that support. But I think it's still in that zone where we can look at 3150 to 3200 as a base building for the next few trading sessions, and there we can look at some kind of consolidation for next few weeks. And overall, that engineering space, that space is going to be in that zone. And sectors as a sector rotation, we will look at more of pharma, and maybe more of even coming days we can look at metals as the next performing sector.
Okay, thank you so much for joining us and giving us your view on the markets and also your stock-specific recommendation. Well, moving on, let's now introduce the Growth Code, a special initiative by Grow and CNBC-TV18 with the aim of empowering investors and traders. Prominent investors and professional traders gathered at Grow's Trading Night event on November 9th to share their valuable insights and strategies. Here's a snippet of Arjun Tandon, partner at Kailasa Capital Advisors, sharing his thoughts on the risk of trading with a small capital. Let's listen it.
Let us say anybody who wants to do option selling. तो ऑप्शन सेलिंग में लगभग 1-1.5 लाख लगता है पर लॉट. अब अगर आपको इन सारी चीज़ों का बेनिफिट उठाना है, आप चाहते हो कि मैं थोड़ा डिफरेंट इंडाइसिस में काम कर लूँ, थोड़ा पोजीशन साइज एक्स्ट्रा रख लूँ, तो मुझे लगता है 10 लाख 15 लाख इंडेक्स के लिए आपको चाहिए ऑप्शन सेलिंग. उससे कम में आप जाओगे तो इट इज़ डिफिकल्ट टू सस्टेन. सी इम्पॉसिबल कुछ नहीं है, हर चीज़ प्रोबेबिलिटीज़ की गेम होती है. प्रोबेबिलिटीज़ आपके अगेंस्ट होती जाएंगी जितनी छोटी कैपिटल के साथ आप मार्केट में आ रहे हो. अगर आप सेम ऑप्शन सेलिंग स्टॉक्स में करना चाहते हो तो नेचुरली आपको डिफरेंट स्टॉक्स में पोजीशंस बनानी पड़ेंगी. कल को किसी भी स्टॉक में कुछ भी न्यूज़ आ जाती है तो वो आपके अगेंस्ट जाएगा. तो स्टॉक्स में अगर आपको पोजीशन बनानी है तो आई फील 20 लाख के आसपास आपको चाहिए, सो दैट आप एक डिफरेंट नंबर ऑफ स्क्रिप्ट्स में आप ट्रेडिंग कर पाओ.
Welcome back to Trading Hour. Well, the Nifty is now mildly in the green after trading largely flattish in the last half hour or so. Bank Nifty too now at the flat line just as we speak. But moving on, Jyotivardhan Jayapuria, founder and managing director of Valentis Advisors, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Jyotivardhan. First up, we've had 9 years where markets have ended in the green. 2025, do you think you can see one more year, or should investors temper their expectations?
Yeah, so I think they should temper their expectations. Hopefully, we end up with a positive year. But, the sort of returns we've seen in the last few years, I don't think, investors should be looking for that sort of return. I would be hoping that we get like a high single-digit sort of return in the market for 2025. But it will be a tough year. It will be a year where it won't be easy to make money. I think there'll be a lot of volatility, which we've not seen over the past few years. So there'll be a lot of ups and downs in the market because there's a new government coming in the US. Will Fed really cut, or suddenly we get inflation spiking again? So there'll be a lot of questions like that, which the investors will have to grapple with.
Yes, it promises to be quite a roller coaster. Jyotivardhan, great to be speaking with you after a while. Season's greetings to you. So I think for Indian investors, it's been a double whammy in the last couple of months, right? Because one, you have this whole go back home to America, buy America trade, which is where the FPI selling has come in. And the second is that we have growth concerns here. I mean, look at earnings. We'll probably end some 5-6% for FY25. There's some expectation of recovery later, but let's see how that plays out. You tell us, in terms of earnings, what are you expecting the market to deliver over the next couple of months? And where would you place your bets?
Yeah, so Sylvia, you're right. So for me, valuations were the concern always, but it's more like the earnings in the economy, which is, I think, a bigger concern. And that's why, you see some of this money flowing out also. Obviously, there's a trade which is go back to American, sell emerging markets everywhere. But if the growth had held up, then probably the extent of FI selling would have not been so much. Uh, the way we were looking at it is we thought the June quarter numbers were also weak. And at that time, the market was probably ignoring it to some extent because the markets were doing well. Um, the good thing for us is we think earnings from here will probably recover. So we'll see a bit of recovery probably in the December quarter, won't be very significant. But I think come March, we'll probably have a better quarter coming. And there are three reasons for this. So one is, we'll see probably spending from the government on the capex side, which was missing so far. So if you think about it, they spent only 4 lakh crores in the first, 6-7 months of the year. And that, we think it could accelerate. Maybe they could be spending like close to 1 lakh crores a month for the next 3-4 months. So that will help, the demand in the economy. The second thing is the monsoons have been good, the crop has been good. And so rural income will pick up with, that crop coming into the cash for a lot of farmers. Third is the liquidity has been eased. So, that was a big move by the RBI and the credit policy where they cut to CRR by 50 basis points. So that's like more than 1 lakh crores of liquidity which will come in the system, and that will start helping earnings. So hopefully as we get into the March quarter, we will see earnings inching back closer to the 10% range. And for next year, we are expecting earnings to be like more in the 11-12% range. So much weaker than the last 3 years. At the same time, 11-12 will be decent. And so, that provides room for getting, maybe a high single digit or low double digit return in the market.
Right. So Jyoti, H2 you say would be slightly better than H1, and FY26 on also probably aided by the lower base of FY25, you could see some recovery kicking in. Well, we want your views specifically as far as the entire BFSI space is concerned. MFI has been in significant pain, so too the rural. So do you think that particular pocket of the market can recover quickly? Especially, you've seen pain there, so MFIs haven't done well. Along with that, even consumption, updates that have come in from a lot of FMCG companies have been very weak.
Yeah, so the way we work and the way we buy, we have this whole 3U's philosophy. So we tend to buy undervalued stocks, which basically are, underperforming and underowned at some point. So for us, we've actually started nimbling into the BFSI space. We've been buying some banks which trade at really cheap valuations. A lot of times when this happens is, there is obviously pain in the system, and that's the reason things are trading cheap. So if we just step back and think of valuations, if we do a 10-year valuation for every sector, then we do current valuations, there are only two sectors which actually trade at like a cheaper valuation than the 10-year average. And one of them is the BFSI space. So we've been looking at banks, buying them. They're obviously, I think the MFI pain will not get over very quickly. I think the MFI pain will continue probably for the next 2-3 quarters. But, there are a lot of other things in the banking space which probably should start to recover a bit. Credit growth has been fairly strong. Liquidity has got improved in the system. And, the banks are trading very cheap and they've done badly. So at these valuations, banks look attractive as a space where, you could, make, double-digit sort of returns in the market. Our selection is more in the smaller cap banks because there are a lot of small cap banks which trade at like price to book of less than 1-time book. And that's why we think the bigger bank can be made. But even some of the larger banks probably are looking very attractive at this stage, at least on a relative basis where the market valuations are.
Okay, so banks, that's one definite go-to place for you. What else, Jyoti? I mean, we've seen a lot of, for instance, we've seen some of the excitement cool down from the PSU pack. We've seen, stocks come off in the capex play as well. Some of these high flyers, MNC high flyers from, power equipment manufacturers, etc. So anything else, anything in this arena or beyond?
Survi, the capex plays, they've got re-rated quite a bit. So if you see in the last 3-4 years, the stocks have done well, the re-rating is quite significant. And so there, the risk now is that, at these valuations, you need earnings to come if the returns have to come. And given that government has been slow in spending, it provides some sort of risk. So in that, frankly, we've been nibbling and selling away some of the capital goods stocks with us where, we've done badly and it has done very well for us. One other space we have been quite bullish on is the pharmaceutical space. So in pharmaceutical, there are two areas which we like. One is, the US generics is something we've been playing in a big way because we think largely a lot of the pricing pressure which we've seen in the US generic is behind us. So prices may still fall, but it will be a very, very low and slow fall. And so to that extent, the big drop in earnings we are seeing for anybody who's in the US generic space is behind us. And we probably see these companies growing earnings quite a bit. The other is, the crime space, which has been traditionally area we've liked. We continue to like it. We think, growth there will accelerate for a lot of those companies. And so these are two spaces in pharma which we like and where, they are relatively more immune from any economic slowdown, which, India may have, the world may have. And so, it's something which you can buy and be a little more secularly sure that, earnings growth will keep coming. So I think pharma is one space investors should definitely look out for.
Jyotirudhan, within the pharma space, you gave us two themes. First one, you expect generic pricing erosion to abate, and secondly, you've mentioned the CRAM space. Now, one other pocket within the pharma space that's done very well has been the CDMO space in hopes of the US Biosecure Act coming in. 2024, that hasn't transpired, but within that particular space, do you like anything?
Yeah, so, when I spoke of the CRAMs, I was including the CDMO and the whole area, So it was generally like I use CRAMs as one technology. But basically, everything else, the CDMO and even the research-driven outsourcing companies, we like that whole space. And, biosecure, like you said, is one area which can further add to the growth. But even if that does not come, basically the growth is there just now. Because a lot of people are outsourcing to India. I think, in general, for a lot of US corporates, it's like we want to move some of our outsourcing away from China to India. So I think, we'll see that growth coming. If the biosecure Act gets passed, then that will probably further accelerate the growth in this space.
Understood that. Thank you so much for joining us, Jyotirudhan, and wish you a very happy 2025.
Yeah, happy New Year to all your viewers and all of you.
Thank you so much, sir. Well, time now for a short break. On the other side, we'll tell you why stocks like Seagull, EPAC Durables, etc. are buzzing in trade.
Welcome back. You're with us on Trading Hour. Let's look at a couple of stocks that have been in focus today. Seagull India is one of them. Now, this is a stock that's been trending higher right from the start, right from the open. And this is because the company has signed a sizable order with the NHAI. Vivek, tell us more about this. How big is the order?
Well, it's a reasonably large size order. It's for one of the subsidiaries, and this particular order is a concession agreement with NHAI, and this is a 981 crore project that the company will receive. So the company, over the period of next 24 to 36 months, will go ahead and implement this particular project. But Seagull India, remember, it's quite a large road EPC company. The order book is quite strong. So this particular order is a little less than 10% of the total order book. Order book currently quite strong at 12,153 crore. What does the company have in terms of portfolio? Currently, 22 ongoing projects, 7 HAM projects as of September 30th, 2024. And when you're talking about the book-to-bill ratio, an important metric as far as road companies are concerned, especially, it's at 3.1 times. So Seagull India, order win, order cheer, plus companies building on to an already pretty strong order book, something that's keeping the stock quite active in this session.
Absolutely. Seagull's been doing well in a market that otherwise is finding it difficult again. I mean, look at the mid-cap index overall, while we're pointing out some of these highlights in terms of individual movers and shakers. The mid-cap index is down about 0.5%. Okay, that's an important update coming in, and it's not that great for users. IRCTC's app seems to be facing some outages, and there's a bit of a difficulty in ticket bookings. Let's pull up the stock IRCTC. It's there on the ticker. It's there. We can see it's down about 1%. Maybe we can get the intraday chart up as well. Yeah, it's been a sort of downtrending day overall for IRCTC. Oh God, this takes me back, way back in time. Usually these things don't happen. But I don't know, Vivek, if you ever went down to physically book tickets at the railway ticket counters. Never did that?
It's been a while. I've done that, but it's been a while. The IRCTC app is actually quite convenient.
Which is what I'm saying. It takes you back into those days because when your number would come to reach the window, suddenly they would say the computer's down, the server's down. No, that is yesteryears. I mean, now, of course, they've really upgraded their systems. This seems to be a bit of an immediate problem. Let's see if the company issues some clarifications on when they plan to resolve it. For the time being, back with more stock-specific action. We're trying to find some specks of green for you in otherwise what's turning out to be a difficult session for the mid-cap market. Like I was saying, look at the advanced decline ratio as well, actually, before we talk about the next stock. Not only is the mid-cap index down 0.5%, the advanced decline ratio that was holding up quite well on Tuesday, it was okay in the morning. Now look at how it's changing. You have almost 1,500 stocks on the decline right now. So the internal nature of the market is not looking very strong in terms of today's trading action. But anyway, like I said, we're talking about some of the stars that are still managing to stand out. And after Segal, EPAC Durables is the other one. Now here there seems to be buzz about maybe some sort of potential stake purchase in the company. We have Upasna with more of the details. Upasna, what's going on?
While the stock continues to remain in focus today as the company clarifies to the media reports stating that Hisense Group, which is China's top TV company, plans to buy 26% stake in company's subsidiary. Now, the company has clarified that the business discussions are currently in the preliminary stage and further has also said that it will file a requisite disclosure in the compliance with applicable laws as and when required. Now, let us look at the Hisense Group, what it exactly does and what it pans out for the company. Now, Hisense was founded in 1969. It is a global leader in home appliances and consumer electronics, operating over 160 countries. Now, it is a MNC with a global revenue of nearly about $29 billion in 2023, and 40% of the company's revenue comes from international sales. Now, company is also known for pioneering technologies like laser TV, ULED, and AI chips, and the company's portfolio includes renowned TV brands such as Toshiba TV, Jonerge, and Asco. So all in all, that's the reason the stock remains in focus today on the back of this news flow with Hisense Group.
Thank you so much for that, Upasna. Second straight session of upper circuit as far as EPAC Durables is concerned. Well, one particular stock, this is a recent listing, which is IKS Solutions or Inventorist Knowledge Solutions. That stock in the last half hour has seen a sudden spike and now trading near the day's highest point, up almost 5%. A recent listing, a relatively subdued listing, but today this particular stock has picked up some steam. But moving on, it's time for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, we are now focusing on one particular sector. Remember, in 2024, the cement sector witnessed a consolidated theme. Nigel is here to decode how things will pan out in 2025. Nigel, over to you.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is, elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
Okay, that was Nigel summing up what perhaps lies ahead for the cement sector as we enter the new year. Earlier, we caught up with Sandeep Ghosh, Managing Director and CEO of Birla Corp. Let's listen into some of the excerpts from that conversation.
The prices have moved up by and large in most regions, except so much in the south. And the increase is modest, though. I would place the increase between 5 to 7 rupees a bag, which is, say, around 150 rupees a ton. So that is there. And I do expect it to be, to hold on. And especially things should pick up further in January once both the cold recedes, and then there is also this whole impact in the north of what they call the Malmas. During mid-December to mid-January, there are no new constructions, particularly in the individual home sector, which start. Large players, again, I think instead of exercising pricing power, they will be greatly focused on costs. Especially one of the large players is, focusing a great deal on the supply chain, doing major disruptive, changes, moves in the supply chain because they have, and that is as per their stated policy. So you will see a lot more focus coming in on cost savings rather than taking huge price increases. That's my overall assessment. But certainly FY26 looks better than what FY25 and FY24 second half was.
All right, that's the management of Birla Corp striking an optimistic note for 2025. Well, with that, we're nearly out of time on this edition of the show. But we're leaving the markets actually slightly uptrending again, at least on the Nifty. You're seeing so much of flip-flop across the green and the red today. The mid-cap index is the worry point. Is now the fall is deepening in mid-caps. But on the large-cap screen, the auto sector is actually revved up quite well. M&M, Maruti, these are some of the key names which are up and about. Vivek.
Well, thank you so much. The auto pack is the only one that's zooming ahead on a day that's otherwise quite weak. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.